Welcome back, everyone, to Vox Markets. My name is Paul, and by popular demand, I am delighted again to be able to speak to Peter Harris, Exec Chairman at Northbridge Industrial Services, a global manufacturer and renter of load banks that are used to test and commission backup power supplies, alongside a leading geothermal and natural gas drilling tools business, predominantly serving the Australasia energy sector. So welcome, Peter.
Morning, Paul. How are you?
Yeah, very good. Well, I'm feeling even better now, having read your AGM trading statement. So big congrats on that. There's lots to talk about. In fact, you've been pretty busy over the last couple of months since your prelims, as I see, since mid-April. So can we kick off with, can you run us through the sort of the year-to-date trading at Creschick, the load bank division?
Yeah, well, you've seen from the trading statement where, we believe we're firmly online for the half year and the full year. Of course, with 5 months behind us, half year is looking pretty solid now. Driven mainly by Creschick. It's been a good half year for Creschick. You'll recall from the full year numbers that we entered the year with a record pipeline for sales of load banks. But actually, the pipeline for rental, particularly on big projects, was quite quiet in the, as we started the year. So what have we seen in the 6 months? Well, the sales of equipment have just continued. The pipelines continue to refresh.
And is the sales to things like data centers, is it?
It's across the range. Quite a lot go to data centers, but a lot's going into the US at the moment, and that goes to a variety of markets out there, including automotive and lots of areas. So demand's pretty widespread. But the data center market, touching on it now since you've brought it in, both for rental and sales, remains very, very strong.
Yeah. Can you just talk through the US opportunity? Because I know we briefly mentioned it, but you had obviously the wildfires in California that took all the power You had lots of blackouts out in California, and still get them, I think, enrolled in this year. And then you had the ones in Texas. But now also, you've got these cyber and ransomware attacks that again are hitting vital infrastructure. And I know it's sort of like people think about it and think, okay, well, we're going to be protected on the network. But actually, if you're a critical, basically opera business, and you need your power to have your services, particularly like data centers, then frankly, you've got to have backup power supplies, presumably, because we've had healthcare systems going down in Ireland. We've had that big pipeline, the petrol pipeline that went on the East Coast. So this is actually getting to be a real sort of like problem for global networks, I guess.
Yeah, it is. It's very sad. For us, it is an opportunity, but it's a dreadful situation to have to take an opportunity from. But you're right. The USA in particular has had some real issues during the course of this 6 months. We haven't actually benefited from those yet. We did well out of the supply of equipment to California last year. We haven't rented any equipment there this year, though there's still the possibility we might. But the big projects, they come when they come, and they're fantastic when they arrive. We're used to the fact that they're, large, infrequent, and a little unpredictable. And then we're not huge in data centers at the moment in the USA. Some of our equipment goes in there, but primarily through cross-hire to other rental companies. We do very little direct work. I suppose that brings us back to what is the opportunity for us in the US. I think it's threefold. Most of our sales at the moment go through our agent on the West Coast, Hawthorne Power Systems, done very well for us for a very long time. Great relationship. We want it to continue. But there's a lot of the USA they don't service. And there is definitely a sales opportunity there, which we're slowly penetrating. But I think we spoke about this a few months ago. Where we struggle in the US is just the length of the supply chain. People want our products. We're not mainstream there because we're higher quality and higher specification than the typical indoor application equipment in the US, because ours is very much outdoor proofed as well. But there is a demand for our equipment. But by the time somebody's gone through the tender process, ordered it, we've built it and shipped it out to the USA, it can be 6 months. So
right, okay.
So what we need to do is get some almost completed equipment out to the US and hold a stock out there, which we can use our service facilities in the US to finally fit out to customer specifications. And that we will do, but of course, as you know, and we'll talk about the factory later, I'm sure, we're production constrained at the moment. So so that will have to wait.
Let's talk about that now in terms of the the actual factory. So I understand you've now got planning permission, which is great. But
it is. Yeah.
You can talk us through timescales and targeted sort of like capacity increases and associated investment.
Yeah. We're actually working with the contractors at the moment. We've finalised the design specs and we're getting prices in now. And there's a sort of, I call it a tailored tender process. So we are putting some competitive tension into the process, but we're not going to delay it unduly by running a full, sort of 2-3 month tender process. So we expect to have final prices and choice of contractor within a month. And then we will break ground really as soon as contractor availability is confirmed and as soon as raw material availability is confirmed. We're pretty confident on contractor availability, though, builders are busy at the moment.
Yes.
Yeah, they are. Yeah.
Just try and get a decorator.
Oh, yeah. Tell me about it. So that's one issue. The other issue is because of the building sector so busy, because of supply chain concerns, post-pandemic, raw material availability and pricing is going to be a bit of an issue. So nothing we can't deal with, but it's just something we've got to work our way through over the next 2 to 3 months.
Yeah, and then so I guess strategically, once you've got that 50% increase in capacity, then that allow you for the US to service it, to basically have a more product out there for sales. So
absolutely.
Okay, so that opens that whole door.
Yeah. I mean, I'd love to say we've got 50% sales waiting for the new factory. It'll take us several years to build up to ongoing requirements for that level of production, but we've got a backlog of putting equipment into the hire fleet, and we've got the stock to build up for the USA. So the factory will be pretty busy from day one. And day one is going to be probably feasibly Q1 next year, more likely Q2, I would have thought.
Yeah. Well, you've got a lot of experience at the busy factory because you've had record order books for 3 years. So
yeah, we have.
We're pretty sure you could deal with that. Now, just on the supply chain, you mentioned in the AGM statement that some of the input costs, you're seeing some input cost inflation. What sort of like is that parts? Is that mainly on the manufacturing side rather than the hire side?
Oh yeah, well, obviously it's mainly on the manufacturing side because the hire fleet is built, and we're not hugely adding to it to the moment. But I'll tell you a couple of things we've done creatively in the first half of this year to rebuild the hire fleet. But yeah, it's very much on the manufactured side and manufacture for sales. And copper prices have gone significantly up over the course of the year. Everything with copper in it has likewise gone up. We knew that was happening at the beginning of the year. We put a price increase in place in January as we normally would. Unusually this year, we're putting another price increase in place in July because the prices have continued to escalate. And the price increases will absorb those material costs. They won't actually impact on margins.
Yeah.
What's pushing margins down a little bit? A very good effect in that I mentioned earlier, we're selling a lot through Hawthorne in the USA, and our agent sales obviously have lower margins than direct sales to customers. So there's a slight mix variance there. And then we're continuing to see some disruption to supply chain and some safe working impacts through the pandemic because we're still carrying on with social distancing in the factory. Yeah. And we're not trying to push those onto customers because we don't see those as long-term impacts. We're prepared to absorb those in the short term and then take the benefit back when things normalize eventually, whenever that may be.
Yeah. Well, I mean, I think it's just a time lag for investors. I mean, the thing is to look, a bit ahead. If if you need to push it, prices to reflect increasing costs. I mean, if you've got Travis Perkins doing it for sort of like cement and plasterboard, then you should be able to do it for a high value sort of load bank.
Oh yeah, and we can within reason. Yeah,
exactly. Yeah, it's just a sort of like a time lag, just sort of like to catch up with it. So the outlook then for Crescik, I think it's positive then for the rest of the year and beyond.
Oh, I think so. Yeah, I mean, we're busy on the major hire projects. That's going to last through the year, as far as we can see. We don't have huge visibility into Q4 yet, but that's always the way. But Q3 we know is going to be solid for us. The pipeline for sales and manufactured equipment remains strong. So the Crescik side we're looking very confidently at it for the rest of the year.
Yeah, and then also on the geothermal natural gas drilling tools business, Tasman seems to have had a solid sort of like first half as well, which is actually a very encouraging performance.
Yeah, it's done pretty well considering the markets haven't bounced back as quickly as perhaps many people hoped. The oil prices recovered significantly, so I think people were hoping that would pull through, but I think that sector is still feeling the effects of the pandemic and the constraints on movement more than others.
Yeah.
So activity has been slightly behind where we hoped it would be, but the guys have done a really good job on managing margin to keep the results overall in line with where we expected them to be.
Yeah.
And we are now seeing quite a lot of inquiries, primarily gas and to some extent geothermal for Q4. So the signs of the uptick, I think, are there. Probably 3 to 6 months later than we hoped, but we've done a good job of accommodating that so far.
Well, that message is certainly consistent with a lot of other sort of like energy services businesses that are coming through. They see it, and I think if the natural gas and the oil price stay at sort of current levels, then I think there's more than a margin for all the big, because effectively, like everybody else, they've been reducing their costs rapidly over the last sort of 5 or 6 years, and actually pretty lean. And their break-even points have significantly reduced in terms of bringing on new capacity. So they can make plenty of money at even sort of like $45 a barrel, depending on obviously what type of sort of crude it is and where it is and that natural gas. But frankly, they're breaking. So $70 gives them plenty of margin to do that. Now,
but it's gas that's doing well for us. And,
yes, exactly. Yeah.
We're pretty close now to opening our branch in Eastern Australia, which we've been working on for about a year now. So, and that's an exciting opportunity for Tasman, Australia. Yeah.
Now, moving swiftly on then, big news in terms of you refinanced with HSBC. I mean, this seems, from an investor perspective, fabulous, because it gives you a real sort of like foundation stone now and optionality going forward, because it sort of solidifies your funding, doesn't it?
Yeah, it does. I mean, if I quote you and our finance director, this is a grown-up facility.
And he doesn't. He's not known for hyperbole, is he?
No.
He's quite a cautious lad.
I know, he's a finance director.
Yeah, exactly.
No, we're very pleased. I mean, in many ways, we're sorry to be leaving NatWest. I mean, they've been with us, right through the journey, and they've been a very supportive partner. But the HSBC offer and the attention they gave us was just, too difficult to ignore.
Yeah.
And what do we like about it? Well, it's a full revolving credit facility, so it's very flexible.
Yeah.
It's in total a higher facility than the previous facilities we had, which are a combination of all the different NatWest RBS facilities plus the convertible, which I'm sure we'll talk about in a minute. They've got the geographic support for us, and the costs of it are attractive.
You talked about in the cost. I think in the statement you said it's an improvement, and I worked the numbers from last year. And I think the facility was sort of like a 3-year facility with NatWest or Royal Bank of Scotland, which was extended to 4, and was running at roughly around about 4, maybe 4.5% or something. Are we talking of that sort of ballpark for the new facility?
I think the previous facilities, I mean, you have to take a sort of weighted average, because
you do.
There was quite a complex mix of facilities in there. Mortgages, invoice finance, conventional borrowing. But that's about the ballpark weighted average there. And I think you'll be looking nearer a 3 now than a 4 on the banking
Fabulous.
side.
So that's going to reduce your cost of capital, isn't it? It's going to
It
sort of
will, yeah. That will help.
That can't be a problem.
No, well, of course, taking the convertible out's another one, because that was just about to go up to 10%, and that was an instrument that did a really good job for us, because we had a need at the time, because one of our banking partners was coming out of the UK market, and we had to replace them at quite short notice in quite difficult times. And Gresham stepped up and put the convertible in place, and it's done a good job for us for 4 years. But it was going to start getting very expensive, and it always had that overhang of the conversion. So I think both Gresham and we are pleased that that's now behind us.
I think with investors, with that new facility with HSBC, the first optionality it gave you to pay off your convertible and to remove that expensive debt, which is absolutely fabulous. And also, what's come out of it is essentially you've got very little dilution. And you've only got, I think it was 75% converted into cash, or it wants to be paid out in cash. Only about £1 million of it is going to be, or just less than £1 million, is going to be converted into equity.
And I think that's sort of good on two fronts. We'd have been quite disappointed if there was no conversion, because we'd have wondered, why not? Because there was, a benefit between the conversion price and the current market price. But we didn't want too much conversion, because we didn't want a wall of shares coming into the market when we don't actually need equity at the moment. So 25% was on the button for us, confidence from our bondholders, but minimum dilution.
Just running the hypothetical numbers. Your EBITDA to net debt is still sort of like under 1, actually, just slightly under 1. And you look at that, and that's comfortable for a rental business. Most of them are running at 2 times. So 1 time gives you plenty of firepower to
plenty of firepower, and we're very, 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 very safe in terms of covenants on the new facility, which is where we like to be. So
good, Matt. Fabulous. Okay, well, just finally then, we've got the Tasman transaction. There was sort of like good progress being made on that. I know you can't talk about it because of sensitivity a great deal, but if you just could quickly run through sort of like time scales, etc.
We launched this, as you know, round about the time of announcing the results, and we've basically gone out to a large number of people over and above those that had put expressions of interest in at the start, which started the process. And we've had quite a few replies, and we're now assessing where we are, how many credible expressions of interest do we now have? Are they in the range of what we would consider fair value? Do the terms and conditions attaching to them, all the things you get in these processes, are they reasonable and fair? That's going to take us a little while to work through. So let's assume that's the next 3 to 4 weeks that we're working through that. And at that stage, we'll decide whether we're actually going to do this year or not. Because
strategically, it might be better if the market turns up as everybody's expecting in the second half of next year, that actually you'll get a more value. I see this as being a win-win situation, because you've got your sort of like your bedrock foundation from HSBC. It gives you optionality. You can hold on to this easy enough. There's actually no problem. It's a good quality business, and if the market's recovering, you might find actually the intrinsic worth is significantly higher in a year's time than now. But if you get a good price, then clearly you'll sell it. So it's a win-win.
I think that was exactly the rationale we said when we launched into the process, that we've had expressions of interest. Strategically, we think there's a better owner out there than us, and that should happen at some juncture. And it was right to explore it this year, and it would still be, if we can get a fair price this year, that will be a good outcome for everybody. Equally, the business is doing fine. And if we have to hold because there's better value in the future, well, that's the right thing to do for shareholders. So we'll make the best call we can when we've got all the information in front of us.
Again, it's upside. Either way, it's going to look good. So now the point is, once you've got that bedrock HSBC, it just gives you so much strength, doesn't it, to progress a number of your internal organic investment with your capacity expansion. Your normal sort of like organic expansion to places like the US. And then likewise with Tasman and with paying off your bond, your convertible debt. I mean, fabulous.
Yeah. Well, we set out our list of to-dos, only 2-3 months ago. And we've knocked a good few of them on the head already. So we're just going to keep working through them. But
good. Okay. So final question then: have you got any more rabbits you're going to pull out the hat then to deliver news flow, Peter? Because you've now whetted our appetite with the sort of the upside optionality. How should investors sort of are you doing a sort of like a pre-close for the half year in July, or are you going to wait until the interims? I don't know when it's September or so. Or
we normally put something out in August, and I see no reason why that won't happen again.
Good.
Yeah.
I look forward to some more rabbits then, Peter.
Well, we hope we'll continue to have good news for you.
Good, excellent. Well, thanks for your time. And if anybody wants to follow Northbridge, just hit the follow button on the Vox website, and you'll get all the news straight into your inbox, along with all the sort of commentary and analysis. So thanks again, Peter.
Thanks, Paul. Appreciate the support.